Okay, I don't know if you saw the news about some sort of Ethereum flash crash. What a flash crash is when the price suddenly drops dramatically and then very soon afterwards it rises again. Now this started, there was one of these the other day on an exchange called GDAX. I'll get to that. We saw the beginning of it in that video, luckily, the other day that I was recording. It's just crashed again in the last 30 minutes and it's terrifying. Look at that! Boom! Yeah, that's actually when it started. Now apparently the flash crash, it's happened in major financial markets before. There was one triggered by algorithms, basically computer programs which taught to trade, and certain events happened and it triggered one, and there was a flash crash in the real world stock markets and scared the hell out of everyone.
Memories of fear are coming back.
What the heck is going on down here? I don't know.
All of a sudden here we started hearing screaming, buy, buy, buy.
The Dow Jones Industrial Average dropped more than 900 points.
The machines broke down.
Fear came back into the market in a very big way.
Because that could collapse the system if it goes wrong, you know. But there was a flash crash in Ethereum, okay, and people panicked, you know. It sort of destabilizes the whole system. Oh my god, it could flash crash again. But it rebounds shortly afterwards. Some people lost money, some people made a lot of money. Why did that happen? Alright, so first thing you need to know is what's GDAX, you know. Alright, so I'm trading on Etoro, okay, it's an exchange. There are many different exchanges. The difference with eToro is that we don't actually own any of the stocks that we buy. None of them. When I go to trade markets and I go to Apple, let's find Apple. Alright, so let's say I click trade and I have insufficient funds because it's all tied up. So I go to the virtual portfolio and I click trade. It won't do. Alright, so I can buy Apple. Alright, that sounds, you know, like I'm buying stocks and I'm buying shares. Thing is, we're not actually trading in the actual stocks. We're trading in something called CFDs. Okay, CFD stands for contracts for difference. What that basically means is that when we press buy on Apple or anything, including Ethereum, we buy a contract which is tied to the real value of the asset. Say we buy Apple. We buy Apple, whatever, $1,000 of Apple we buy. So we buy an exact mirror copy of the real stock, but we don't own Apple. If you own enough real shares in a company, you can actually turn up at the company one day, hostile takeover, and you're the big cheese. You can sit at the head of the board table, I own Apple now. We can never do that. We're trading contracts for difference rather than the underlying actual stock. What difference does this make? So we can use more leverage. That contracts for difference are actually banned in the States because of this. Still, all over the world, contracts for difference, CFDs are fine. They're a form of derivative. Still trade them in Europe. England, that's fine. Belgium, I think, is getting rid of them. Belgium's banning them. So contracts for difference, if the real stock goes up, our thing goes up. If the real stock goes down, our thing goes down. So we can buy them or we can short sell them, and it doesn't make any difference. We can use more leverage, really. People in the States have apparently had to turn to something called options trading to make use of, you know, good leverage and stuff. Doesn't matter. So why that matters is that when you're trading Ethereum and Bitcoin and cryptocurrencies, which have been really big on eToro, everyone's in it, it's making loads of money, it's all wild, and that's where the flash crash happened. There are other ways to buy cryptocurrencies. We trade CFDs, contracts for difference. So we buy a certain amount of Ethereum or Bitcoin. If the price goes up, our thing mirrors that and our price goes up. In the same way as if you owned it, but we don't own it. Okay? We see almost like a mirror image of it, and that's what we're trading on. Other people actually want to buy the real coins, the actual coins. Not that they're real and fixed anyhow, they're still just digital things, but they want to buy them and hold them. Meaning they have to buy them and they don't have a stop loss. Their ultimate stop loss is if it goes to zero, because they still own it, it's just worth zero. So they buy them and they just hold them and they wait. They can still trade, but it works slightly differently. There are many exchanges where you can do this. Kraken, Poloniex, Coinbase. Now Coinbase is also linked to another exchange called GDAX. GDAX is where this flash crash happened. Why did it happen? someone put in a massive sell order, very, very large, millions of Ethereum they sold. And obviously, economics works by supply and demand, right? If you have got if there's a lot of houses on the market, then basically, and not many buyers, then all the sellers try and compete and they put their prices down so that people will buy them. If there are very few houses on the market, restricted supply, and there's a lot of demand, lots of people want to buy houses, all the people who own houses think, well, there's not many of us, they all want to buy. I've had like 20 offers, I can put my prices up. So the price goes up. So, same thing with Ethereum, with Bitcoin, with anything, supply and demand. So when someone suddenly dropped, I don't know, millions worth of Ethereum on the market, all of a sudden the supply went up. There's tons of supply, same amount of buyers. What then happens is the price automatically goes down because there's just a lot more on the market. Price goes down. Another thing happened though. That's the real value or the economics model. What happened is a chain reaction happened. So they sold at a certain price. Let's look at the chart of Apple just to work this out. Alright, let's look at this bit here. This is a huge sell-off in Apple happened. It's not huge, but it'll work. So let's say here in the chart was dumped all the money, okay? All the Ethereum was dumped. So naturally, because of supply and demand, the price starts to go down because there's more of it, there's the same amount of buyers, price starts to go down. As it dropped down, people had set stop-loss orders. You know those orders where you can just walk away from your computer and leave it and you've predetermined a value. If it loses this much, sell it. So people had set stop-loss orders at different levels on the way down so that to protect their money. Preservation of capital. I don't want to lose my gains, okay? So, as it dropped, the value, because of this big dump, it started to hit lots of stop-loss orders. Now each stop-loss order says, alright, that's enough, like, I don't want to lose any more, sell mine, sell mine. So it sold some more and hit another stop-loss order. And that said, alright, sell my position. So it sold some more. Went down again because there's more supply and more supply because all these stop-loss orders are being hit. It's like dominoes. Remember there used to be domino rallies, 80s, 90s?
Everybody knows about playing with dominoes, but what you may not know is that a domino can knock over another domino which is about 1.5 times larger. Ready? Boom.
That was a big thing. You only press the first one and then this chain reaction happens and things just start to happen. That happened to 800 stop-loss orders got triggered on the way down. As the stop-loss orders get triggered, there's more and more available on the market, supply increases more and more, value goes down, more stop-loss orders, works like dominoes. It just, brum, it starts a chain reaction. And eventually, apparently, it was trading at like 10 cents. Man, if it bought it at 10 cents. But we're not on GDAX. Here's another thing. So that's what happened, and then they corrected it quickly. They did all sorts of stuff. They're having to reimburse people who lost too much money because it was their system. It was a failure of, it was a mathematical anomaly. The original sell-off would have lowered the value, would have lowered the price, but all the stop losses being triggered and subsequent panic and bad. But then obviously they worked this out. The real value of the asset hadn't changed. Ethereum hadn't suddenly, someone hadn't said, Ethereum's useless now. If that happened, maybe it goes to zero. Fine. But this was caused by maths. So what happened is that quickly people worked out, my God, it's not actually worth 10 cents at all. It's still worth like $320. Buy. Everyone buys it, boom, it goes back up again. That's why it's a flash crash. It goes down quickly, people work out, whoops, that's just maths, buy it, goes back up to where it should be. So, why wasn't there a flash crash on our exchange, on Etoro and stuff? Something to do with how Etoro develops prices. So, let's say I go to, I'll go back to the real portfolio, and I go to any given stock. So let's say look how well I've done on Zendesk, 62.80. Anyhow, so, say I go to Zendesk. Here's the price, yeah, that we see on Zendesk. Where does that price come from? How do we know that? So what this does, eToro does, is it pulls many different prices from many different exchanges and it finds a sort of average. So I don't know how many it is, I think it's hundreds of exchanges. and it will find the different price on all of these ones for Zendesk or Ethereum. Let's go to good old Ethereum. It's the first one that pops up. So it's finding that price. It's looking at all these different exchanges and it's tying in the price here. So that's how we get our average price of things. The prices will be different on different exchanges. There's actually a thing called arbitrage, which is where people buy from one exchange and sell to another really quickly and make a lot of money that way. I don't know how to do it. I'm not smart enough. If I did, I'd be like a billionaire. But that's how we get our price. So GDAX, this is where the flash crash happened, on one exchange. However, eToro doesn't pull information from GDAX, but GDAX then is owned by, or is a subsidiary of, or is in charge of another one called Coinbase. So Coinbase also registered that crash. Many others then start to register this crash. So we did see the effects of it on eToro because we're taking so much information from so many other exchanges. We saw it. But only GDAX itself is the only one which registered the massive crash, because we take an average. We'll take a bit from we'll take Coinbase's data and other exchanges' data, but we don't just take that. We take an overall thing, so it sort of balances out and makes it a bit safer. We're not subject to the same massive crashes that were on GDAX. Having said that, eToro released a statement. Let's see if I can find it. Just the other day, I can't find it. And it was just after this flash crash. They released a sort of notification, which was a little bit scary, saying that, you know, this is what happened on GDAX. There was a massive flash crash. We want to preserve your wealth. We don't want this to happen to you. So as a result, we might trade. It's very volatile. We might suspend trading at certain times. We might be able to, that you can't get out your money. You can't close positions. You can't open new positions. And what that's basically saying is that they're preparing for this to maybe happen again. All right. So cryptocurrency is very, very volatile. They already removed the leverage, so you can't put ×2 leverage on Ethereum or Bitcoin. But it looks like they're preparing for a bit more volatility, and they're getting everyone ready that if this happens again, they're going to suspend trading and stuff so that we can't trigger all these stop losses, and this stuff won't happen on eToro. They're trying to work out how to make it so that they don't get lawsuits and they don't have problems and people don't go bust and start screaming at them. So it does look like, by that statement, we might be seeing it again. So yeah, we trade contracts for difference, which are tied to the actual value of the asset underneath. Other people do trade in the real coins. That's not us. One of those exchanges had a flash crash. Those exchanges are also insecure in other ways. They get hacked a lot. They really do. There's a lot of sort of cowboy stuff going on with crypto exchanges. My brother actually lost about 60,000. It's a lot of money on one called Mt. Gox, Mount Gox. Long time ago, it got hacked, and all the Bitcoin and all the Ethereum, or Bitcoin at the time, got stolen. So they do get hacked, and there are problems. But they're trying to make them more secure. But anyhow, we're doing a different thing.